Hey everyone, welcome to another episode of the Everyday Trader. This is Greg Jensen, CEO at Options Animal. Good to be here with you today. Um, got a little bit to talk about today. The markets have broken to all-time highs, so I'm interested to have a conversation with you today, Eric. How are things?
Things are great. As you always say, interesting days in the market. And I think you do. You start every day, every time we get together and I broadcast daily or weekly. So you'll comment, this is interesting day in the markets, which I think is more a reflection of you than anything, because you are truly interested in the markets. But we are at another all-time highs in the S&P 500. We've got the S&P 500 currently at 531108, and the Dow Jones Industrial Average is busted above 40,000. We need to get Art Cashin's out with his hat. Actually, it's dropped back down a little bit below 40,000. I was just looking on the DJX. So we did go above. We were, as I started talking, then I hit refresh. We're a couple cents below that 400 left. So this is the Dow Jones Industrial Average Index. So it's off by 10. So 400 is equivalent to 40,000. So we were over 40,000, and Art Cashin's is a legend in trading. He used to always have a hat for every one of the milestones. I remember him with a 20,000 and a 25,000. So he's probably sitting somewhere with a 40,000 hat on his head right now.
I'm sure he is probably somewhere in a club in South Florida. Retired. He retired a few years ago from the floor, and yes, definitely a legend. And uh, obviously a legend because he still follows the Dow Jones Industrial Average and thinks that it has any meaning to the markets.
What are you trying to say? Only old people follow the Dow Jones Industrial Average?
Let's be honest, the Dow has not really represented the market for a number of years now. It's only 30 companies. It's dollar cost weighted as to what moves it, not necessarily market cap weighted. And so it's arguably, it generally goes in the same direction as the major market, the S&P 500, which is a much better indicator. But it can also sometimes be very different in its reflection based on something that United Healthcare might be doing that day, as you know, one of the big high dollar components of the Dow Jones Industrial Average. So yeah, typically when I'm looking at the overall market, I'd rather look at the S&P 500, but we're still at all-time highs today, breaking through. And I'm proven wrong from the last time we did a recording, at least so far, in that my double top is getting broken through to the upside right now. We broke through on the S&P up above 5,300 yesterday on a big, strong move after misinterpreted CPI data.
What? Yeah, exactly. Okay, there you go.
Because I say misinterpreted the headlines. If you read yesterday's headlines after our CPI number came out, it was yes, inflation's cooling. You know, Jerome Powell's his progress. They're making progress on inflation because it came in lower than expected. Well, yeah, that part's true. Although we were expecting a pretty hot print yesterday, and it still was showing and indicating that inflation is still present. They haven't conquered it yet, but the market, the media wanted to celebrate a win as a win, and so we rallied on the news, and yeah, broke through that high there of about 52.65 yesterday. It was the old all-time high, and pushed through it on decent surge in volume too. That was one of the arguments that I was looking at the last couple of weeks, is we'd really had a drop off in volume. And so had a nice spike in volume. I shouldn't say a spike. A spike would be like what you saw back in March or back in December. Those are spikes in volume. But we're at least seeing increasing volume going into this rally we've had the last couple of days. So um, yeah, markets rallying.
On
Except
the
for
CPI thing, I imagine the newsrooms sitting around, and I envision something like Mad Libs. Do you remember Mad Libs when you were a
yeah,
kid?
yeah, yeah. My
So
kids
the
love that
paragraph
list.
is written and
Yeah.
there's just a few keywords that are blank. And so CPI, it's either met or beat or fell short of, and the market either loved it or hated it, and they just fill in the blanks. And they do it after the fact. You know, it's like, oh, whatever happened with CPI, and if the market went up, the market was what the market expected. The market definitely did move on CPI, but I do think the read was not, as you said, it's a misread on CPI, and I don't know that it matters. Uh, as far as I think the interpretation is wrong. I think the message is the same. I think the interpretation is that the best thing that can happen is for the Fed to not do anything, to not change rates. Historically, that's the best regime for the S&P 500 is when there's no change in policy. The worst thing that can happen is for the Fed to cut rates and there to be a recession. Now, a better thing to happen is for the Fed to cut rates and there not to be a recession. So the question is, are we going to have a recession or not? And we'll get to that. I want to show some data talking about that, but I did want to dive a little bit deeper into the CPI. And I know a lot of people look forward to this monthly analysis that I do, where I take the monthly changes and I sort them by importance. So this is a list of major components of the CPI. It's not quite everything, but these are the level 4 components with the exception of motor vehicle insurance I added. But if you look at the top 12 or so items on here, and again, I think the squint analysis, you don't have to be very scientific. You just kind of squint your eyes on this and look at the things that are important, which are the blue bars measures the importance. Are they on the right side or the left side? So the right side's going up, the left side's going down. And most important things are skewing to the upside. And if we get a 4 print, that would have been really bad. And we rent of shelter is 4, medical care services 4, transportation 0.9, to education and communication. Now I know a lot of you are like, well, I'm not paying education, but communication is your cell phone bill, your cable bill, which I don't know how the hell did my cable bill get to $197 and I'm still paying money streaming. I'm gonna have to take a look at that. I was just looking at my cable bill. How am I paying $200 a month for cable? And I mean, we don't even watch cable TV. Everything's streaming. Anyways, different story. But what did come down? Okay, new vehicles and new cars. So new
Used.
vehicles, used. I'm sorry, yeah, new vehicles overall and used cars and trucks. I'm sorry, new vehicles down 4.4%, used cars and trucks down 1.4%. Now, how does this affect the average consumer when
Well,
the
the
average life of a car is 12 years? How often do you buy a new car, Greg?
Yeah, exactly. I mean, you don't buy new cars very often. I mean, I buy them for myself a little more often than my wife. My wife is very frugal. I bought her a new car in 2007. She's still driving it. She loves it. I bought her an Escalade and she still loves it. And that's all she drives, 17 years later. Now, I buy, my truck's a 2020. So it's only a few years old and I'm kind of itching to get a new one. But even then, it's a 2020 and I'm looking at 2024. Maybe every 4 or 5 years, I buy a new vehicle.
Do you buy yours in the middle of COVID?
I did.
That was, yeah, I remember that experience. I don't remember the details. I remember you. Yeah, that
Yeah,
was
I
a weird
bought
timing
it.
buying a car, right? Because nobody had them.
I bought it like right before COVID took off. And so I actually timed it really well because my truck actually
Oh,
went
that's right.
up.
You
My
could have
truck
turned
went
around
up
and
in
sold it for
value.
huge profit,
I
right?
could have made like 30 or $40,000 on my truck. I should have sold it and bought Nvidia.
You should have bought Nvidia. What were you thinking? Or you
Oh,
or
hindsight, right?
Eli Lilly or somebody else or
Yeah.
oh, there's some really crazy stuff. We'll talk about some stocks to watch here towards the end. But looking at the CPI, there's the Fed is looking at it at this level. Fed doesn't look at CPI other than this isn't what their benchmark is. The PCE is their benchmark, and that's coming up. But PPI was a little hot. This was a little bit. The read was down. Okay, so we've gone from a sucking chest wound to just a minor arterial bleed. The number isn't going down. It's just not going up as much. A number 3.4 is an increase. It's not going down. It's just not going up as fast as it was before. So it's still increasing at a rate that's unacceptably high, and it does need to get down. And there's enough air cover, especially with unemployment being relatively strong. We get some jobs reports that come in last little bit of concern on the last jobs report, but labor's strong, the market's strong, the customer earnings, earnings, 1% of companies beat. I saw a summary this morning, 1% of companies beat on revenue. No, the average beat on revenue was 1%. The average beat on margin was 11%. So companies are feeling it a little bit in terms of revenue, but they're able to make it up by improving margins. Overall, companies were pretty much past earnings, with Walmart being behind us now. Pretty much all companies beat earnings with way more than what was expected. So the economy is solid, and that, it's perfectly rational to me that the market is doing what it's doing.
Yeah, I saw a report just last week after we were getting to the end of earnings. And at this point, 95% of the S&P 500 had reported earnings. And it was 77% was the number I remember of the companies that had reported so far, had beat expectation, had decent looking forward guidance. And in essence, it was the strongest earnings report we have had, strongest quarterly report we've had in over 4 years. Going back to just coming out of the back end of COVID in 2021. And so, yeah, earnings are really solid right now. And Walmart's earnings kind of reflect that same concept. They came out and they beat expectations. They raised their guidance. They see a strong, resilient consumer right now who's still out there spending money. And in fact, they're pretty confident that that's going to continue. So I have a hard time seeing, what you kind of led into this discussion with. I have a hard time seeing us slipping into recession right now, especially as the job market continues to be strong. And if you want a job, you can pretty much find a job. It is interesting to see some of the pundits out there that are adamant that we are just on the doorstep, if not already in recession. And I just don't see it. I see a strong economy still, pretty much everywhere I look.
Well, objectively, we're not really sure what, the magicians on high passed down the reading of we're in a recession. Was it NFIB, national NS, well, the National Association of Business. What's the bureau? There's a
No,
four-letter acronym. It drives me. I hate acronyms. I freaking hate acronyms.
it's
But
not
there
the
is
NFIB. It's
and no, it's the national.
yep,
It's got an N in it. It's got national. It's got an E in there.
yeah,
It's got a B.
NAEA.
There's a
No,
B because it's a bird or Bureau of
NABE.
Economic Statistics. BLS? No, that's not.
NABE.
There you go. There you go. These guys get together, and it's really a little bit of a mystery as to what they use, but it's generally accepted it's a combination of employment, industrial production, retail sales, and income. So it's technically a recession's 2 quarters of negative growth. And leading indicators, these are the big four. And I'm using Advisor Perspectives, our friend Vetify, Dave Nodig over at Vetify. They purchased Advisor Perspectives. The quickest way, by the way, if you want to get to these really cool economic charts, people, D Short, who was Dave Short, is no longer, he's gone for a long time, but D Short takes you right to these charts. If you try to go to Vetify or Advisor Perspectives, you'll never find them. But if you type in D Short, it'll take you right here. They do a great job with the most recent economic reports. And one of the ones that I always look at is this big four. And so the employment, industrial production, retail sales, real income as a leading indicator, probably the most solid leading indicator. And I've been watching these guys for over a decade. And when they're all red, if you go back historically, this starts since the last recession recovered. So this is when the last recession ended, which was a COVID recession, and they were all red, right? Everything was red. And so employment is positive, industrial production, retail sales was down just ever so slightly. So there's some, I mean, this is not a solidly negative number. This is 0.3, and we've had bigger numbers. This is 1.39. That one had people a little bit freaked out. That's not a really big number. These are going to trend. We're going to start seeing most of these be red before we go into recession. Recessions do tend to come upon pretty quick, and the COVID recession was not your average recession. And this next recession is probably going to be the result of something. There's all of the past recessions have happened because of one or two reasons. Something cataclysmic like a war or an epidemic, or it's been a credit crisis. And these things are unknown. It's we don't know what causes them. The global financial crisis was a black swan because nobody saw credit default swaps failing. Technically, COVID was not a black swan. It was a very statistical event, but not a black swan, because in the book, The Black Swan, it specifically says we will have an event that's a pandemic that will cause markets to crash. So by definition, it's not a black swan. Doesn't mean it's not significant. But right now, my read is, the trend is your friend. There are reasons to be concerned, but they are not, they're dim yellow lights. So it's not a flashing warning red light. I mean, there's some stuff that's, flashing a concern here. The inverted yield curve has been going on for a long time. I swear this time is different. It'll be the longest ever that we've had the yield curve inverted. Are we going to have a recession? I think we will. But you know what? Fourth year presidencies, there's a huge moving driver to don't screw it up, because we all want to get reelected. So typically a really good year. Going back full circle, I am confident about my 5,420.69 prediction. I think we will see 5,000, see the S&P 500 at 5420.69 is my end of the year prediction, and we'll start to see that happening. We are above a lot of the institution forecasts, which was where, having us in December, they were between 51 and 53, and they're not raising their forecast for the rest of the year. Goldman Sachs has looked at their forecast and says their end of the year forecast is below where we're at right now. So we'll see what happens if that changes, but I'm bullish.
See, and I love that you're bullish. I'm bearish still. I still think we're again for a double top. Now, that doesn't mean that I'm bearish on the economy. I actually think, because I think you can have a bullish economy and a bearish stock market. And that's what I think we're set for. And the reason why is I'm still of the opinion that we will not see a rate cut this year. I believe that.
Now you're stealing my thunder, because that's my line. No, but actually, I think we're going to see them raise rates. So okay,
we could. I actually think the Fed has not stopped inflation, regardless of what the headline said yesterday. I think inflation is alive and well, and on its way to peak again. And I think it's going to freak people out again before the end of the year, and we're going to have a pullback sometime. Maybe it's in the summer. Now we could still rally at the end of the year, based on some actions maybe the Fed takes towards the end of the year. Maybe we get some seasonality at the end of the year. So I think we could still see numbers in the realm where we're at right now, but I actually think we're going to go lower, just because I think inflation's back. I don't, at least I don't think the market will be as volatile as GameStop, especially with Roaring Kitty back.
Roaring Kitty,
right?
Oh my gosh, that's a bunch of. Okay, I'll say it, bullshit.
They made a movie about it, right?
Oh, you haven't watched it?
I still haven't seen it.
You have.
Dumb Money, right?
How can you? Dumb Money. Yeah, they're making a sequel right now. It's called Dumber Money.
Dumber Money.
Dumber Money. I'm kidding. I'm not kidding. But listen, something was up. Somebody knew. This whole thing got front run a week ago. So Roaring Kitty didn't come out until like a week ago. So it was like last Thursday or Friday. The stock was hanging around 12, 10, 12. And all of a sudden it jumps up to 17. And you can, it's in this graph, it's really kind of hard to see. Let me zoom in a little bit. You can see all of a sudden back here, the volume started jumping up, and some people knew. So there were definitely some private channels where people knew that Roaring Kitty was going to come back. And as soon as we get this tweet of him, it was a very, I don't know, coded tweet. It was just a picture of a video guy, hand sketch picture of somebody leaning back in a chair and then leaning forward. And with that, we've seen GameStop take off to the moon. And, it's, I'm one of these things. If you don't understand why the price is changing, if it's working in your favor, great. That means, but it could go against you for the same reason. this is fascinating to look at. I don't have FOMO from not being in it. I'm not.
Yeah,
I want
me
to trade it
neither.
bearishly. I actually did look at doing bear calls on this trade, but the liquidity is terrible. The option prices are terrible. And all it takes is, a few more tweets and this thing could be at $130. So
Yeah,
it's fun to watch and talk about, but these aren't the way that you make
yeah.
consistent profits.
What I feel bad about are the people that are trying to follow his trades, or this price action, whether it's people who are on Reddit and reading the message boards on Reddit, whether to follow them on Twitter or wherever it is where they might be following. Uh, in most cases, there was somebody out there that bought the stock at $65 2 days ago, and it's now trading at what, 20 something, 29.04 according to your chart there on the screen, down another 26.5% today. Now that somebody's down 50% in 2 days on an equity position. If you're trying to time it with YOLO calls, you're down 100%. You've lost 100% 3 days in a row now. You may have just blown your account up. The way, again, this is the way people made an enormous amount of money in 2021, the last time he was around. So I
All
actually
right,
think
listen
this
to this,
action,
Greg.
I think it's criminal.
Here's a post on Wall Street Bets. This is from Degenerate Trader number 10 is his handle. Okay, hear me out. What if I take out 2 loans for the same amount of money? I purchase both calls and puts for the stock. Worst case scenario, I lose 100% of one of the loans, but that would mean that the other loan pays off in a profit, which I can use to pay off my loan while keeping extra profits. The logic is I can only lose 100, but I can win 100% more. What are the downsides to this?
Wow. It's criminal, Eric. It is criminal that the SEC allows this to happen.
And this is what people are saying. There's people saying, well, that's not my fault. And somebody was saying that hedge funds, blame the hedge funds. What, blame the hedge funds for what? I mean, you dumb enough to jump on this? I mean, this is I love the idea of people making money, who are maybe on the outside. But you're not going to go in this game and play this game that you've got whales that are moving billions around. Everybody pointing fingers at Ken Griffin. Like, don't fault the guy. He's done well, and you're going to get mad because you jump in his game and play by his rules, and you don't win. Whose fault is that? Nobody made you get in. You don't have to get in the market. And man, if you put money that you can't afford to lose in, yeah, I'm okay. I don't have FOMO. I'll be honest, I do have FOMO. I want to try and make money on this. I'm like, in hindsight, I think, well, if I put 100 grand in here, then, I would have had, 300 grand, 400 grand, and maybe you retire 2 years earlier, 3 years earlier, and go buy a couple Cybertrucks. I don't know. Um, I just
It's
hate to see people get hurt. That's the thing
I
that
do too.
yeah.
I do
So
too.
somebody bought at 64.83, and now they're down 50% or more, and they're going to take a haircut. Maybe no, who knows? Maybe they double their money. It goes back to 130.
It's just it's flat out the casino. This is what the Wall Street's version of the casino is. And yeah, AMC, there's another perfect example. Wasn't even really mentioned. I think if I remember right, what I was reading, the article or the tweet was about GameStop.
There was no tweet about
Oh,
GameStop.
there was no tweet
There
about
was
GameStop.
nothing. It was just roaring quitting, and
Roaring Kitty.
He's roaring kitty, and he's posting nonsense videos of just short little snippet videos from movies that everybody's trying to figure out what they mean. He hasn't said anything about any stock, and nobody even knows. It may not even be him because the account has been dormant since 2020. So it could be somebody just figured out his password and they're just posting stuff out there. So that there's no let's go jump on GameStop. Nothing.
It's another sign, Eric. It's another sign that there is still too much liquidity in the market for people to continue, like for nonsense video like this to come out and all of a sudden they're chasing a stock again. There's still people who are willing to go take these types of massive risks. If we were in a really tight economy, that the Fed had actually conquered and was sending us into recession, you wouldn't see videos of the dude, right? That wasn't that the dude from
Yeah, there's a dude, and I mean they're all just little short little videos. There's no
Jack Black. I forget his character name in School of Rock, but yeah.
it's all short little iconic scenes from movies. Like, what are we supposed to interpret from these? What does it mean? I don't, nobody, there's nothing. It's all these just video snippets. And, where do they come from? And I'm trying to get to I mean, there's just, it's almost spam. I can't, I mean, is he doing all this? I'm trying to get back to the first one here. I mean, the last real post that he had was in 2020, and that was at the top of the list. So this pin post this is from August 2020.
Well,
It's okay not making money on, you don't have to be on it. It's okay if other people make money and you don't make money. Yeah, here it is right here. So Roaring Kitty, this was 2021. Okay, that was the last post.
it's almost 3 years ago.
3 years ago. And then on May 12th, he posted this image of a guy leaning forward. So, and that was enough to send GameStop through the roof. But here's the thing is GameStop was going through the roof a week before this post happened.
Yeah.
So somebody knew something.
So it probably is not a hack. It was probably an intentional, maybe it was a hack, but it was then an intentional move of they front ran the run up in the stock and then turned around and sold it. Turned around and sold it to all of the poor schmucks who, said, "Oh, GameStop's back, Roaring Kitty's back. Let's go screw the hedge funds again." And the same game's going to work this time. And unfortunately, if you jumped in 2 days ago, you're getting crushed. Now, you're right. The game might be back in play again. And there's a chance that this thing rallied, because if you look at its history in the past, it did similar moves to this, where it would go up 200 or 300%, and then it would drop 100%, and then it would go up 200 or 300%. And so this is a name that I'm not willing to gamble on. I'd much rather gamble on legitimate trades like this one. I don't know if you're sharing this one.
You and I are both in a trade on Palo Alto networks that we shared with our community at Trader Oasis, a straddle trade. So this is a trade that'll do really well if the stock moves. And the basis on this is based on some logic, and that is that right now the options are pricing in an 8% plus minus 8% move. Historically, over the past 8 quarters, it's moved on an average of 12%. So both of us are in slightly different trades, but they're explosive trades that are going to do really well. Earnings for Palo Alto is on Monday after the close. And it's a little bit more of what I call an idiosyncratic trade. These sort of trades only come up every quarter. There are, other trades you would do consistently throughout the week, throughout the year, that work in multiple directions. Sorry, a text response. I gotta respond there. So everything's cool. So yeah, this is one I'll give a little peek behind the curtain, but this is one I shared today. We typically share about eight ideas like this. So we'll see how this does on next week on Tuesday. And yeah, so were we going to tip? Is this what we're going to talk about? We said we're going to talk about what we'll talk about on the next episode. What is that?
Well, next week we have a couple of big earnings reports, and one of them is Palo Alto Networks. So the other 2 big ones are next week as well, are Nvidia and Snowflake. I shouldn't say Snowflake is a huge, influential company in and of itself, but it is one of the poster children of the meme stock move, and it's had a lot of movement with the excitement around AI. So we get 3 still relatively big tech names, and obviously the biggest of all tech names right now in Nvidia with earnings next week. So what are your thoughts on Nvidia next week? I mean, their earnings numbers the last time, if I remember right, were pretty solid. And it's that big red candle to the downside, isn't it? I don't remember.
Yeah,
No, it's the gap up.
there's the gap up because
It
it
was the
traded
gap
down
up.
ahead of time and then went up. Yeah, it was a huge gap up. It's if I had to put my money on it, I would bet another big gap up. And that is definitely the institutional consensus on Nvidia is the price revisions are all pretty astronomical, all over 1,000. And they do have something really compelling. I'm not trading it right now. I mean, if you wanted to look at a cheap trade, something like a call credit spread is like a lottery ticket instead of buying calls and puts because they're pretty expensive. But you buy a call and sell a call, it might cost you $200, but potential upside could be eight. So with a $10 wide spread, if you can find something like that, if you do get that sort of move, I'm cautious right now on Nvidia. I am a firm believer in AI. There's another sort of line of thought of how do you take advantage of AI, and another industry that's emerged is looking at utilities across the board. And if you look at the utility space, which is usually pretty much a snoozer, pays decent dividends, and companies like Southern Company, NextEra, are in here. Constellation Energy Group is another good one. So I think those are among the top generating companies, and energy usage is um, being mentioned by almost every single company that's involved in the AI supply chain, and that it's a critical finding reliable power because A, these need power, and B, they need cooling. So they need air conditioners. I know all of the utility companies, it's pretty much on their front page of all of their press releases is this incredible, insatiable demand for electricity to meet the AI need. And it's real because this is happening. I mean, every time you run one of these AI queries, which I am doing all the time, there's some server that's kicking up someplace and burning electricity. So this is another interesting sector, and I think a really
I got to
interesting.
tell you an interesting story along that line, just to put it into perspective. So, where our offices were located in Lehi, Utah, a number of years ago, this was probably 10 years ago, the government the NSA specifically, built a really massive building there that hosted all of the servers that are storing all of our data that they're capturing legally through the Patriot Act, right? But that's where it's at. All of our phone calls, all of our messages, our internet activity, it's all stored on these servers that they built in this big giant bunker of a building. It's just right outside of Lehi, Utah. But I knew one of the electrical contractors in there that had to go in and help them because they were using at that one facility as much electricity as the entire city of Provo, Utah. So 100,000 residents were not using as much electricity as this one server farm was, and they kept overheating things. They actually had to divert a reservoir that's supposed to be used for drinking water supply to help cool these and run it through the building to help cool the server farm down as well. And again, this was 10 years ago. This was before the explosion of AI and Nvidia's demand for chips. This was just back when they were just storing our data. But yeah, it's an interesting problem that the AI growth is dealing with is electricity and the need for demand for it. So yeah, we're getting this, like you said, we're getting almost this alternative or derivative type of play off of the AI popularity in this, like to use your words, a snoozer of a investment usually.
Yeah, utilities usually a snoozer. You got to be careful with utilities. There's a whole bunch of different sorts of utilities that are in there. I think the unregulated independent power producer ones are the ones that are probably best suited. And like I said, I think NextEra, Southern Company, and Constellation Energy Group are on the top there. The other sort of thinking with AI is anything that gets built, and this is true with all construction, all manufacturing, everything uses copper. And we're at all-time highs on copper today. So that's which leads you to think about, well, maybe we should consider companies like Freeport-McMoRan, so FCX.
Not a bad play, because you not only have copper at all-time highs, you've got silver at highs that we have not seen since 2011. I know Freeport's a big player in the silver mining. You've got gold just off of all-time highs. Yeah, the miners. Yeah, Rio Tinto.
So these are indirect AI plays. So playing the miners, and they have other. If you're bullish on manufacturing and looking at some of the infrastructure that's likely to be built, at least they're talking about, these are possible plays to look at too. So looking at raw materials, I think Rio Tinto, Freeport-McMoRan are interesting companies. Those utilities, like I mentioned NextEra is a good one. Southern Company is another good one. And then look at that Southern Company, man. And then Constellation Energy Group is another one. Oh, down today. So this is a big nuclear utility. This is Exelon. Some people know of Exelon. Look at this thing. It's gone from $80 to $230 in a year. This is what it's talk about a snoozer. It just snuck up on everybody. How does something like this happen without people? Why is this not front page news? I mean, we're talking about AI and we're talking about GLP-1 inhibitors. This definitely deserves some attention. It pays, well, the dividend is a little bit high right now, but if you were able to acquire it around the hundreds, the low 100s, had a really nice dividend. So it would have been about a 3% dividend. Yeah, so there's some opportunities in here to buy these companies. Be careful. I think the collar trade is the right approach if you're going to buy the stock, because we could see these things popping back down. But they're stocks to definitely put on your watch list.
Well, we shall see. We've got the kingpin of earnings announcements from the AI space and Nvidia next week. So I guess we'll get Palo Alto Networks first, and you and I will see how we do in our trade. So,
or these ideas that we came up, or you could just YOLO it and go buy, go take out a second mortgage and buy calls that expire this week on GameStop.
Seriously, you're really trying to make me cuss, aren't you?
I love it when you get fired up.
All right. Well,
hey, the market closed, so let's just get
closed.
a final print. Market just closed. Oh man, the S&P 500 was down today. Oh,
52 didn't finish above 5,300. Maybe my double top call is still in
play. Yeah, and the Dow Jones Industrial Average negative prints today.
Oh wow, we actually went negative on the Dow also, huh?
I don't think we've seen the top in this market.
The double top is in play. We'll see next week. Actually, we still got another day tomorrow. The market's not closed yet this week.
Yeah,
we're open tomorrow. Let's see what.
Are we going to get together tomorrow? Do another one of these? Maybe, I know you say maybe, probably not though.
Probably not. Probably not. Are you doing the oil weekly tomorrow? I'm not. I'm next week.
I think I am. I think I am.
All right. I think I'm the next week.
Well, have a good one. We'll talk to you later, my friend. We'll see you, everybody.